Hello, I'm Julia Dreblow of SRI Services, and this is me running through some thoughts on the sustainability disclosure requirements and labelling regime that was proposed in a consultation paper by the FCA a few weeks ago. The consultation ends on the 25th of January 2023. So a quick introduction briefly to who I am, who we are. So I run a business called SRI Services, where the main thing we do is run the Fund Eco Market database tool, which enables industry professionals, or it's aimed at industry professionals in financial services, matching client aims to fund strategies, to what funds actually say they do. Our information comes direct from fund managers. I've worked in the area for well over 25 years. We have a lot of users on the site. I work with a number of intermediaries also, and I'm one of the members of the FCA's Disclosures Enables Advisory Group, and also involved with the BSI work, writing a PAS, so a fund standard, the first step towards a fund standard in this area. My background is that I've worked in this area for a very long time, previously running the SRI, or Sustainable and Responsible Investment side, at a company called Friends Provident, who launched the first ethical fund in 1984. And I do all this because I believe it's important. I believe it matters where we invest, and I believe that clients' views are important, and also I believe it makes sound financial sense as well. The first thing to discuss is language. Terms in this area get used and abused all the time, so let's just run you through broadly what these terms are taken as meaning, and will increasingly, I believe, we'll start to articulate more precisely what this means, but this gives you a good understanding of what we're talking about as we go through this presentation. Now, sustainability, or if something is sustainable, it means it can carry on forever. When we're talking about ESG or ESG focused, we're talking about really focusing on risk to the fund. So what are the risks of a company messing up and causing a drop in share value which will affect investors? Whereas impact, you're turning it the other way around, you're looking inside out, and you're trying to have real world impacts rather than just looking at benefits to individual investors. Stewardship, we're talking about responsible ownership strategies, we're talking about what an asset manager does with an investment that they hold. Ethical is more about personal values, how one feels about things individually inside. A lot of the ethical issues, bear in mind, firmly social or environmental issues also, so a great deal of crossover between the areas. Screening is about avoiding or selecting assets on a particular basis in line with a particular policy that the fund says it has. Tilting is about going overweight or underweight in particular types of companies. Integrating means also considered, so if a fund says they integrate ESG, it doesn't mean it's the main focus of their strategy, it means they do look at it. And if a fund says they're aligned to something, it means you've got a strategy that across the board is in line with a particular aim, say perhaps with the aim of reducing carbon emissions by 7%. It doesn't mean to say necessarily every company in it will be doing that, but the fund is aligned to that. So why is this area important? What's going on? Well, the backdrop to all of this is, and always has been, the lifestyles that people lead and the fact that many people want to see positive change. So it's not the only factor. Of course, we're talking about investments here. People invest to make money. That's what keeps the money going around. However, we know our lifestyles, the way we lead our lives today, is warming the planet, destroying habitat, and ruining lives. Now, you'll forgive me for not dwelling on the negatives for too long. It's thoroughly depressing, but the good news is that we know where we've got to get to. There's been a lot of work done on this for many decades in some areas. And we know, for example, that we've got to shift from having a linear economy where materials are brought up out of the ground, so raw materials essentially, and then either burnt or buried when we're finished with them, to a circular economy where we keep materials in the loop and we keep recycling stuff, and it goes round and round in the same way as nature deals with things. People have got to start leading their lives in that way also. We've also got a firm focus on the need to get to net zero. We must drop our carbon emissions or greenhouse gas emissions massively if we are to stop catastrophic climate change from really changing the way everyone leads their lives and being an absolute disaster for all of us. So we've got to get to net zero. So that's a target that we've set. And as you will know, the UN and others have been firmly working on this for a long while. And progress is being made in many areas. Overall, we're not there yet, clearly, but we've got a pathway mapped out ahead of us. And then we've got things like knowing that, frankly, we've got to take people with us, because it's very easy to talk about environmental issues and forget that none of the changes that we want to have happen will work if we don't take people with us. So there's a lot of work going on in the transition area, where we're saying, okay, how do we transition from here to here in a just manner, which means that we are making sure that people do not have their lives ruined by that changing process because they would put the brakes on for us. So we've got to take people with us. They're central to the changes that need to be made. Hence using the term sustainability, which covers environmental and social, rather than just focusing on environmental issues. So the backdrop to SDR is firmly in the commitments government's already made. So we ratified the Paris Climate Agreement in 2016, so we agreed it in 2015. We developed a net zero strategy. It all came together into a strategy paper 2021 ahead of COP26. So there is action happening, and this basically sets the foundations for the changes that we're now starting to see. So that brings us to what's happening in retail financial services, what's in progress, what's started already. So I'm going to run you through that over the next couple of slides. As you'll see, I'm zooming in to the SDR paper, but it's really important you understand the background as it sets the context for the paper. So an important document in this area was the government's roadmap, Green Finance Roadmap, that was published in October 2021. This really sets out the main areas that the government wants the finance community collectively to address. So everything really that's happening today and all the different strands of investment are all signposted in this document. And just in case, you should be minded to say, why are we being picked on? Be aware there's been changes going on across different areas of the investment community at all different levels for a number of years now. One of the key things to come out of the Glasgow climate talks was GFANZ, the Glasgow Financial Alliance for Net Zero, $130 trillion worth of investor assets basically signed up to saying we're going to commit to making sure that net zero happens, that the transition happens. And there's a lot of companies working on that already today, and they have been for some time. And then again, looking at a different level, we've got the International Sustainability Standards Board that was launched recently, that is still very much work in progress. The UK government welcomed it in just August 2022, so very recent, but it's been worked on for a long time, bringing together different bodies to then set international standards that will then sit under the IFRS badge, which is the accountancy, people who run the accountancy standards, international standards for accountancy, and bringing the same kind of rigour to assessing sustainability issues as we bring to financial issues. Obviously, the financial requirements were developed over this course of decades, if not centuries, whereas we're having to do it a lot faster on sustainability. But be aware, standardisation in this area is coming, and it will be helpful. I'm sure it won't go without the occasional glitch. I'm sure there will be things that need refining, but this work is happening and it is important. Okay, so retail markets, what's happening in retail is the next question, the next few slides. Right, so although a lot of this work predates this, it started off beforehand. There was a big change at the FCA in March 2021 when the Treasury basically sent a remit letter, or change of remit letter, to the FCA saying that they should have regard for net zero commitments in everything they do. So it's a document that's linked to in various FCA papers, but it's important because before that the FCA wasn't able to formally build net zero and therefore the sustainability agenda into what they did explicitly. There was a lot that was by implication, obviously treating customers fairly and true, fair and not misleading obviously applied to all areas, but so there was quite a big change that took place in March 21. From that there were then some guiding principles, set of principles that if you've attended my events in the past, you'll have seen us running through these. But basically these all signposted the work that is starting to happen now. And so you can have a look at the principles online. The priorities for ESG were set in November 2021, and the various papers, you've got a work programme that was set out at that time as well. So this has all been signposted for quite some time for the industry on the retail side. Transparency, trust, tools, transition, etc. were all being discussed previously. So that brings us to the sustainability disclosure requirements and investment labels consultation paper. Important, this is a consultation. The FCA is looking for feedback. It closes on 25th of January 2023. but it builds on the discussion paper that was published in November 2021. It's moving that forward with a view to it becoming a new set of regulations and new rules and clarifications mid-2023 and mid-2024. So some of it will go live next year, most of it will go live the year after. Right, so you understand the background and where this has all come from. Let's look at what the SDR paper actually says. I must admit I had to laugh when I saw that the header in the paper saying what the FCA wants to change, but there you go. So there's basically 6 core areas that the paper covers. The first is labelling, bringing in some labels so that a client can see whether or not a fund is seriously, properly focused on and its purpose is about sustainability or not. So labels to make it far easier for investors, individual clients and anyone who wants to use the labels to see whether or not a fund is specifically really focused on sustainability. The next area then is consumer facing disclosures. These are the core bits of information that will have to be put out to enable individual investors, retail clients, real people with their ISAs or whatever product area we're talking about, but particularly on the investment side, so that they can see broadly what a fund does, how it works, what it considers, what it's looking at. And then there's going to be the next level down, which will be for additional information for whoever should want it. Now, its core focus was meant to be to help institutional investors, to help big investors in products, and those who perhaps in the industry would need to dig a lot deeper. However, the FCA has understood that, of course, there are many clients who have got a really good understanding of this area and would need to have access to that information also. So that covers, there's a list of the different bits there, but so the detailed disclosures will be around pre-contractual information, so the information that has to be available prior to someone investing in a fund, ongoing sustainability performance information, so annual information being put out about how a fund is performing, is it meeting its objectives, if a fund is, for example, avoiding a particular type of characteristic and supporting another particular type of characteristic, can the fund prove and say honestly that that is what the fund has done over the course of the previous 12 months? And then there's the entity level reporting, sustainability entity level reporting. This is going to be for asset management groups being required to basically build on what they're already having to do under TCFD, but talk about how the company itself addresses sustainability issues. The next point, number 4, is naming and marketing rules. So funds will no longer be able to use terms like ESG, sustainable, responsible, green, or whatever in a willy-nilly fashion if they can't prove and substantiate why they've used those terms. They will not be allowed to use them. So again, this comes back to the core aim of being about addressing greenwash. So make sure the names of funds are right and appropriate and make sense and don't run the risk of misleading people. Likewise, marketing rules, there'll be terms that are protected. It doesn't mean to say that you can't mention stewardship, for example. If you only do it as a bit of a bolt-on, you will be able to, but you'll have to make sure it's proportionate and sensible and not misleading. Then there's going to be a set of requirements for distributors. We'll come on to that in a moment, but basically if you are distributing these funds, you are a really important part of the chain, and if the information is going to get to end clients, we've got to involve distributors in this. Otherwise, you can put all the information you like online, but if no one tells a client to look at it, then they won't see it, or if it's not put in front of the client, it won't work, so the system would fail. So we've got to have requirements for distributors as part of this process. And then there's going to be a general catch-all, which is, if you like, an anti-greenwash, what's referred to as the anti-greenwash rule. So basically just reinforcing what should always have been in place anyway, but don't mislead people. Make sure that if you say you're doing something, that you're actually doing it, that it's not being blown out of all proportion, made to look like it's the be-all and end-all, when actually it's just a tiny feature and bolt-on of a product. So greenwashing is a major focus of this paper, and the anti-greenwash rule will basically underpin everything that this paper is about. So there's a couple of images here which you find in the document, which there's a load of explanation around it, but these help give you an idea of the main focus. We're talking about information flow, reducing greenwash, and basically helping people to navigate the market. And there's pre-contractual, there's sustainability reporting and for funds, and sustainability reporting for entities. So these are the core areas of the report. So you'll have noticed I've started to bring the word greenwash into this, so it's worth looking at what it is and what it isn't. So the key purpose, the reason this regulation really, or primary reason this regulation's come about from the FCA's perspective, is because clients are being misled. There's a lot of fund managers out there who may think they're doing something really amazing, but perhaps they're rather more early stage than they realise they are. So what is it? Greenwash is really about overstating your environmental credentials for financial gain. So companies are benefiting from attracting assets by, if you like, bigging up what they do above and beyond what's realistically the case. It can be intentional or unintentional. I firmly believe there's a lot of really good people who've got involved in this area recently who have moved a long way from where they were previously, but actually they don't understand the way clients may interpret words, and they're perhaps not terribly experienced in the area and don't realise that actually they have over-exaggerated it. So we're starting to see this being tidied up by the FCA and making sure that any claims can be substantiated and proven. Not telling you specifically what to say or what to do, but just to make sure you're not massively bigging up what you do and potentially misleading people. So why does it matter? Well, the first thing the FCA is worried about, of course, is client trust. We can't have clients being missold to and then criticising the industry in newspapers and media, etc. That needs to end. It needs to be dealt with. But it can also distort markets and asset values, because of course if funds are saying that they're doing one thing and actually doing something rather different and investing in ways that a client would not expect, you're driving money towards assets that a client would not expect their assets to be driven to. And given the size of ESG now, that has the ability to distort asset values. Now, on the lower end, of course, we can't always track exactly what's changed in asset value, and clearly this stuff is multifaceted, but it's got to be taken into account. But basically this is about misleading and mis-selling and trying to deal with the fact that clients must not be misled. You've got to be realistic and honest and straightforward in what you're putting out to clients. And bear in mind, these are my words, not the FCA's. Okay, so I talked with the FCA on this. I am not the FCA, as you know. I don't work for the FCA, but so these are my descriptions. But broadly, I'm sure they hold. And I'm just going to dig into this to give you examples of what we're talking about here. There's obviously different elements. There's a lot of people saying all industries are greenwashing now. They do, and this needs to be ended across the board, across all industries. But I've talked briefly about greenwash, but there's also people use the term rainbow washing for use and abuse of the SDGs, and then impact washing, overstating the real world impacts and benefits of doing certain things. There's all sorts of terms that have got the word washing bolted onto them now, but you'll get the gist. So let's start with what companies do. So individual assets that are held within funds. We get claims that get put into the public domain that fund managers are being bombarded with. Things like there was a tobacco company recently were claiming that they were relying to one of the UN Sustainable Development Goals, SDG 3, saying they were going to be offering consumers an even greater choice of tobacco products, focusing on quality, innovation and reduced risk potential. Now that is not what the SDGs were ever designed to do. It may be a good thing that the products are slightly less dangerous, but we're talking about a tobacco company selling tobacco and basically cigarettes. So clearly that is abuse of the SDGs. There's also issues around climate pledges in particular, because they've been massively in the spotlight. So for example, companies where they're saying, oh yes, we're going to get to net zero, but nothing that the company's done, or very little that the company's done, points that they've actually got a plan in place and it's actually going to happen. And perhaps they may have conflicting activities. So for example, a bank may be financing increased extraction of fossil fuels out of the ground whilst talking about their amazing green finance strategies. The two are clearly in conflict, and we've seen one of the biggest banks in the world being fined for that by the ASA recently. This kind of stuff needs to stop. We need to get some consistency. The problems, if you think back to my earlier slides, the problems are now so massive that we simply can't let this carry on anymore. It needs dealing with. And of course, there's the other bit. A lot of companies simply have no transition plan at all. And then you've got some companies that are making claims that are simply false. You may have seen the Panorama program recently with a company that uses biomass. They're saying that the carbon that they emit, greenhouse gases that they emit, are different from those that come from coal, because their carbon emissions don't go into the atmosphere, whereas carbon emissions from coal do go into the atmosphere. That is clearly nonsense. All carbon that is burnt goes into the atmosphere unless you've got some kind of carbon capture process in place. So there are claims that on the face of it may look good, but if you understand the issues, you can just see it's complete nonsense and a false claim. So this is the kind of stuff that fund managers are being presented with, being lobbied with, if you like, by companies all the time. And the way that can come through in fund strategies is an over-exaggeration, over-exuberance and enthusiasm for how good the strategies are and for perhaps how good their stocks are. There's often things like lack of context, lack of explanation, reasoning or evidence. It may be that the fund manager doesn't understand the complexities of the situations that companies are meant to be dealing with. There can be all sorts of reasons. Another classic one is poorly explained tilts, where an asset manager will go slightly overweight in a particular area or underweight in a particular area, where they're not excluding areas, they're just reweighting, rebalancing the portfolio slightly. And that's been really problematic. It's not a bad thing, so long as it's explained, it's absolutely fine, but it's often not fully explained. And then you've got the issue of surprise holdings. We've got lots of stocks that people look at in funds and think, how on earth did that get in there? Now, that's a problem for the industry. We don't want companies to be, or asset managers to be bombarded with letters saying, why is this in there, why is that in there? Because we all know the scrutiny around this will increase. We know that NGOs will do what NGOs do, which is pick holes and try and drive the standards up. So let's go on the front foot on this one. And then there's the lack of understandable information. So it can be gobbledygook nonsense information or just a complete lack of information. And then another good one, of course, is around ratings and data providers and that kind of thing, where we're basically seeing all these numbers being bandied around that makes companies look like they're amazing or funds look like they're amazing, when we can see that, broadly speaking, they're not going to deliver net zero, they're not going to move us to a circular economy, and they're basically not going to deliver as someone would reasonably expect. So we've got to get this information in context. We've got to rein it in to make sure it doesn't run the risk of misleading people. Right, so if you understand what the FCA is trying to deal with and why, that gives you a good way to be able to understand how all the bits of the SDR paper come together. So the macro aims of it: improve trust, guard against greenwashing, they go together. But also we're trying to help meet client needs better. So we want to make it so that a client can understand more easily what a fund does and whether or not it's going to be suitable for them. And the key parts to that then, if you like, are the labelling, which will basically highlight the key similarities and differences. Within each of the labels there's going to be variation, right? We don't want all funds investing identically. That would be insane. It would create bubbles. It would not enable the fund industry to cater for diverse client needs. So there will be variation within each of the labels. Do not expect all the funds to be identical. Don't think that you have to run them in identical fashion. You don't. The detail, however, will sit in the disclosures, as I've said. And the main parts of that will be sustainability objective. So what's the goal, what's the purpose, what's the sustainability objective or aim of a fund? Should be a pretty short statement where the fund manager, similarly to what they would say on the financial side, what you would say on the financial side, just explain what the aims of the fund are from a sustainability perspective. And then you've got the investment policy and strategy area, where you'll be expected to set out what the fund focuses on and how it operates. Okay, so basically telling people what the fund does. It can be more focused on environmental, it can be more focused on social, or it can balance the two to be really a very balanced approach to sustainability. All of these things come in scope, so just set out what it is you do and why. Again, this does not have to be chapter and verse. You don't have to write an encyclopedia, but you've got to set out clearly what it is you do and why. And then you've got to have KPIs, so things that enable you to judge whether or not you've done what you say you've done. So can you prove that definitely if you say you invest in this kind of company, or you're targeting this kind of change or this kind of impact, can you prove that you've actually done that? And that should be useful and informative for the asset manager as well as for regulators, clients and everybody to see what it is you're actually targeting. And then in order to make that happen, but the FCA will be requiring you to put out information on the governance and resourcing of this area. So basically, have you got a management structure in place that will make sure excuse me, that will make sure that what you say is going to happen is actually going to happen? Have you got the right people there? Have you got the right inflow of information, the right research? Have you got some checks and balances in place that will pick up any issues as they occur? Because let's face it, stuff changes all the time in this area, so you're probably going to have to be staying on top of the issues to do with individual companies, both from a sustainability perspective and a financial perspective, if you are choosing to use a sustainable label. Obviously, as I've said before, you don't have to use the label. If you want to use the label, these are the things you're going to need. And stewardship, so the way in which asset managers deal with individual companies that are held within the portfolios, is going to be really important to all of these strategies. So what's the relationship that an asset manager has got with the company? How are you voting your shares? How are you engaging? What bits are you focusing on where they need to encourage change, where you should be working towards progress? So these bits all come under the package. These are the kind of things that good asset managers already do in this area. So it should just be a matter of making sure the right information is in the public domain, laid out in the right places, easy for people to find, and in a structure that makes sense and integrated into the materials that are available to clients and others. And as I said before, this is about entity level and fund level. So very often you will have companies who say, well, across the board we do this. It doesn't just apply to this sustainable fund, it's what we do as an organisation. So in order for this to all work, we've got to be able to make sure that information on the entity is published, as well as being fund level strategy information, because the two dovetail. And this is going to take some working through for some fund managers, I'm sure, but the two are relevant. So congratulations, yes. Both of them need to have information in the public domain. We've already seen the start of that with TCFD. This is building on the TCFD reporting that asset managers have to do. So be aware, the last point on the left-hand side here is that these proposals, they do touch on non-sustainable funds as well. So there will be funds that have chosen not to use the label for whatever reason, but are still doing stuff to do with sustainability, ESG, responsible ownership, etc. They won't be able to use those terms willy-nilly, but they will be able to use them so long as they're explained properly, in context, proportionate to the degree to which it impacts the strategy and the objectives of the fund. So be aware there will be requirements for companies to disclose how it is that they deal with these areas across the board, and for funds that are not labelled as being sustainable. So let's revisit for a minute how the FCA got to this position. So I've been talking to the FCA for a long while on this, as no doubt have other people also. This has been a big issue for quite some time. The industry has not been very tidy. So there has been loads and loads of consultation. The FCA has made a real point of talking to those people who know what they're doing in this area, and also those who are newer to it, plus client research, financial lives surveys that the FCA has been carrying out, loads and loads of research being gathered increasingly by the FCA. So understanding how real people feel about this. We know from their research that the FCA is well aware that something like, depends on which of their bits of research you use, but 70 to 80% of people have got a pretty decent level of interest in this area. So if the FCA knows that generally people are interested in sustainability, then they know that this is important to clients, and there will be a spectrum of views, there'll be a spectrum of funds, but they've pulled together client information, consultation with the industry, in order to develop this latest paper, and then the policy that will follow that we published. We're expecting it to be around summer 2023. So that's their basic process, how they got to where they are today. Beyond this paper, and it's worth setting this in context a bit, there's all sorts of issues around allocation of capital. I touched on it earlier, but basically where money goes and doesn't go is really, really important. It makes a difference between being able to finance and drive change and encourage better behaviours for existing companies, or not being able to if companies are seeing the way money's moving. And that obviously complements the stewardship side. There's also a lot of work going on the international side, lots of collaboration, lots of work happening, IOSCO being an important area of that, and also TCFD. So there's lots of different areas here that the FCA is involved in trying to pull this together to make sense of it moving forwards. This paper, the SDR, is about retail funds basically. Right, so on to what the paper proposes. 3 labels: sustainable focus, sustainable improver and sustainable impact. The FCA has done this to look deliberately non-hierarchical because they're of the view that each of these areas is hugely important if we're going to get to that sustainable future we want, so they don't want it to be seen as a hierarchy. Sustainable focus funds will basically be for those funds that focus on holding companies that are demonstrably good at sustainability issues. They've got high standards, they get it, they're companies that will be able to continue into the future because they understand and manage their environmental, social and governance issues well, but for the purpose of this paper focusing on highlighting the environmental and social aspects because governance is integral to both of those. Then you've got the improvers category. Now the improvers category is for those assets where fund managers have decided to hold controversial stocks in companies, controversial stocks in their funds, with a view to improving what they do, to driving positive change. So rather than just excluding or focusing on good companies, they're saying no, we're going to keep those contentious companies in the fund and we're going to work to improve them. Now the fund managers in this group are going to have to prove that what they do is credible, that the companies within there have got an ability to and a willingness to improve, so we won't be able to just put anybody in willy-nilly. But so that's the improvers category. And then you've got the sustainable impact category, which is all about driving real-world positive changes, so making investment decisions where the intention of the asset manager is clearly to drive real-world change, obviously alongside financial performance also, because we are talking about investments here, but real-world impacts. We want to see measurement, we want to see information that proves that the fund itself, the way or the assets, have actually helped to deliver a real-world change. Right, so to expand on the labels a little bit more, we know the world's not perfect, right? We know we've got these massive challenges that we've got to deal with. We know that most companies are, if you like, on the left-hand side of this graph, where they're pretty much operating in a way that cannot be sustained. They're chucking pollution into the air, onto the land, into water, whatever. Loads of improvements have been made in many companies, but we've got a lot of dirty companies, and we've got a very small number of really beautifully clean green companies that are completely unlike any other in that they are all about sustainability. But the vast majority of companies we've got are somewhere in between the two. So stewardship and engagement is within each of the strategies, but what we've got to do is to drive collectively together companies generally from being more on the polluting side and more towards the green side if we are to basically reach net zero and achieve our sustainability aims, which means that future generations will be able to achieve the same standards of living that we do today. So we've got to move everything across to the right. So there will be a big focus on driving positive change in the improvers label. That's what that label's largely about. So if that's primarily what your fund is about, then basically you should be putting yourself in the improver category. If you're somewhere in between the two and the company's basically doing a load of really good stuff, and that's what your assets are all about, whether it be bonds, whether it be property, whatever. But if basically you're looking at companies, organisations that are sound but have got room for improvement, then the chances are what you should be looking at is the focus, sustainability focused area. And then if you're on the right hand side and we're talking about investing in companies and assets that have really struggled to attract attention and to get the kind of growth that they need in order to succeed and scale, then you're on the right hand side, and that's really where we put the positive real world impacts and your impact type funds. So as I say, companies are complex. None of this is perfect. Do not expect perfection. Don't expect things to remain static. Stuff changes all the time, but that's the general idea. We've got to go from brown to green, a lot of imperfect stuff in the middle. We need to move it all up the line, and the three different strategies focus on, the three different labels focus on highlighting the three different main areas within that spectrum. So you may have noticed that in the FCA's press release when this was launched, they talked about guardrails. So the FCA, Sashstan in particular, talking a lot about guardrails. So not trying to tell funds exactly what they must do, but just setting the parameters within which they can operate. Because let's face it, there's a lot of innovation that must happen that simply hasn't happened yet, or it hasn't attracted the investment that it needs yet. So we're setting guardrails, not fixed rules. And how do we know that we've got all this variation? Well, for 12 years now on Fund Eco Market, we've been splitting funds into their different SRI styles, and we've observed and cut funds into different groups, different SRI styles. Some funds focus more on ESG, ESG plus. I've expected to see more than just ESG integration. Some are tilted, some focus on faith and ethics. Others are deep dive more about just social issues, just environmental issues, or sustainability focused, bringing those both together. So we know there are different strategies, but we also know that they map differently to different client needs. Okay, so different clients will be looking for different things. Some will want to invest in a fund that's just got a bit of sustainability in it. Others will want to, so it may well be that a standard fund, a regular non-labelled fund, may be suitable to them, who knows, or they may want to focus rather more on it and say, no, I'm not going to be comfortable unless this fund has a label, in which case you've then got to start choosing between the strategies in future. So we know the variation exists today. The FCA is not trying to get rid of this. They're trying to just make sure it's represented properly and that clients can make right decisions that make sense for themselves. Now, this isn't a presentation on Fund Eco Market, but I'm going to use this chart to illustrate where the problems have arisen recently. What we've seen over the last few years, particularly since the Paris Climate Agreement, is we've seen loads and loads of funds in this ESG plus and tilted or limited exclusions category that have launched, that are very, very light touch in terms of altering where they invest. So they will invest largely in line with a standard or relatively standard index, and clients have been calling them out for greenwash. Now, if their stewardship activity is solid and they're really working to drive change, there's no reason. Those funds are entirely legitimate, but they've not been communicated. People have often thought they're buying a deep dive sustainability themed fund where all the assets will be clean and green, and you know, they may expect the odd kerfuffle, but they would expect very, very high standards, and they haven't had that because the fund strategies haven't run that way. Now, some managers have explained it really, really well. Others have not explained it well, but this is where the problem comes from. And really, we've seen this area on the left with the red circle around it. Those funds didn't exist a few years ago. They simply weren't there. So these are all broadly new type strategies. So that's why we've seen massive inflows to a lot of these funds, and they just need communicating properly, and they need to up their standards if they're going to meet clients' reasonable expectations. And of course, in order for that to work, what we've got to do is have the whole investment chain working together. So the FCA refers to this as the causal chain. I touched on this at the beginning. It's important if you're a distributor, if you're a portfolio manager, MPS, DFM, multi-asset fund, whatever, just be aware you've got to communicate what you do properly and make sure that it gets through to clients. So that right the way down the chain, if it's then being shown on a platform, if it's being shown on wherever you're distributing, however you're distributing it, the information has got to make it through to the end client, and the FCA is very well aware of that. So a little bit more on what the paper says for distributors, platforms, portfolios, etc. are all part of the chain. So you're relevant, you're in scope. There are implications for sustainable and non-sustainable funds. There's section 7.9 in the paper goes into this. So just be aware, whatever you're doing, you're likely to have to talk about this. For portfolio managers, the paper proposes 90% of the assets within a portfolio must be within a single label in order to use that label. There are question marks over that, but anyway, that's what the paper says. I'm not a huge fan myself, but anyway, I'm just trying to show you what the paper says. You should expect to need to have links through to the individual funds, so you won't have to reinvent the wheel, but you will have to provide links to the various fund manager information, text, etc. on sustainability. And overseas products will be dealt with later. Overseas funds can use the labels, of course, but they won't all be obliged to if they're offshore, etc. So that kind of area will be picked up in more detail later on by the FCA. Bear in mind that the intention of all of this is to be in line with PROD, consumer duty, and all these other requirements to make sure that if you're making a claim to a client, that you're dealing with them decently, and that you're not misleading them and thinking that sustainability is irrelevant or a bolt-on. This fits within all the existing rules. There will be advisor guidance, there will be work happening, rules change. We're not sure how it's going to work though, so early days. We're going to get the system set up for funds first, and then once we know the structure, the FCA can start looking, and we can start consulting on and feeding into the FCA what we think will and won't work in the intermediary space. But bear in mind that there's already rules in place under COBS, etc., that say that you should be identifying your clients' needs and meeting them, and loads of stuff here saying that if a client is interested in an area, you should be advising them on it. You're the expert. You should be checking whether or not your clients are interested. And keep in mind there, for goodness sake, that the FCA has been doing research for some years now, and they know that loads of people are really interested in this area. They don't necessarily want to invest 100% in, you know, solar panels or whatever, but they're genuinely interested in this area. So if your numbers as to where you're directing capital, directing clients' money, is massively out of line with what the FCA understands the general public's opinion to be, then you may well have questions to answer. So for goodness sake, get the processes in place that mean that you can prove that what you do is appropriate. And then the last point here, bear in mind this will evolve over time. So obviously we don't want new rules to come out every 5 minutes, but realistically this is a massive subject and it affects everything in investment. There's no way that any regulator can have, you know, come up with one piece of regulation and then just leave it done. If they did, they'd probably have to set the standards way higher, which would make it unachievable for most companies today. So this will be an ongoing process, and at current state we're at the moment is they're asking for feedback on what they publish, so please do feedback. So broadly, how is this going to help you? How is this going to help distributors, fund managers and everybody else? It's going to simplify the client message. It will make it so that people know whether or not they're dealing with a fund that's trying to improve companies or already invest in sustainable assets, or if it's all about impact. So the idea is that we make it a lot easier for clients and therefore for the industry to cut through. And the package is all about avoiding greenwash, and clients will be better able to reflect their views and feel that they're part of the solution going forwards and helping to solve problems, which we know is what so many clients are interested in. And it's going to help you to prepare for future changes also, because we know a lot more is going to be coming on this area. We know that the risks and opportunities related to sustainability issues are already massive, but you just need to look at what's happening in the world at the moment to know that this will increase. These issues are all interconnected, they're getting better understood, and financial services has got a massive role to play. None of the changes that need to happen can happen without finance being part of the solution. The FCA knows that, we all know that, so therefore we've got to play our part. And as I say, this will continue to evolve. Now, if you're not understanding the business aspects of this and why the economy will shift and how this all comes together, I really recommend that you read Donut Economics, 7 Ways to Think Like a 21st Century Economist. Kate Woolworth, Oxford economist, fantastic book. Have a read of it. If you do one bit of reading on the subject, this is the first book I would suggest you go to. Right, I'm not going to dwell on this massively, but I am going to just say a few words on the fact that to me it's clear that the paper is not perfect yet, and thank goodness this is a consultation. So these are some of the things you might like to look at. The sustainable focus label sets the bar pretty low. I would say it allows 30% of assets to be in unsustainable or so-called unsustainable assets. I think that's setting the bar rather low, lower than clients would want. The impact fund bar has been set by contrast very, very high, and there are issues of the combination of those two. The improver label, there are some people who are worried it's open to abuse. It may well be that too many funds think that they can fit in that category. I think they've got that covered with the requirements to prove the interest, the ability to shift, but who knows. So do feedback on these kinds of issues. There's also issues around the distributors and platforms portfolio stuff. It's how will the anti-greenwash rule work? The 90% rule for a single label I think is challenging. The practicalities of having loads and loads of different links on fund platforms may be interesting, may be difficult, and also just the labels that some platforms can and can't display. So there's lots of different things in the paper that I think are well worth people feeding back on, but these are just some examples. There's also issues around scope, the timings, how will that work in practical sense for portfolios in particular, and platforms, so scope, timings, investment trusts, offshore funds, etc. Whether or not this is covered by pension funds, institutional funds. Those funds can use these labels. We'll be able to use the labels that's in the paper. However, is it going to cause confusion if some do and some don't? We'll see. Anyway, these are things that people are asking questions on. And then there's the, well, where does this leave ethical funds? Well, this paper is about sustainability, as I've said, but there's probably room for starting to be a little bit clearer about what it means for ethical funds. And then generally there's a concern. This is a load of work. This is going to be hard. So that's another feedback bit. But I think the answer to that probably is, well, guess what, guys? It's been flagged for several years now. You should have started this process already. But anyway, there is an awareness and a knowledge across the board. This is hard. There's also things about the taxonomy. How useful is that really for retail and for real business and real companies? There's also issues being raised about investors. If you're a big US house and they've got the antitrust issues going on in the States, how's this going to work in practice for those companies? So there are issues that will remain, that the FCA will be looking at, but that's just a few general pointers for you. So the important thing here is this is a consultation, so respond. And drilling into a few positives, because it's really important when we respond that we say good things also, right? Because there might be other people who disagree with the positives, and if they only get negative comments on something, then it may land up going, when actually a lot of people have just taken it as being a slam dunk. This is definitely okay and it's going to be part of it. So if there are things that you like, please do make that point also. Things like requirement to have objectives for the funds, just make it clear what the fund's for. I've been saying that for decades. Tell people what you do and why you do it and what's the aim of it. Really, really good. I love that being in there. It gives a structure to the market and transparency. It's going to aid understanding. There's a really clear focus on clear, fair and not misleading. That's great. People have played around with this, not been totally straight for a number of fund managers, particularly over recent years. So that's clearly a focus of this. There's also a comment in there about surprise holdings. Now, I know some people are going to find this hard, because they're not really embedded in sustainability, but this paper is all about sustainability. So if you're making claims about sustainability and you say a fund does something and you're not able to understand which holdings in your fund might shock clients, then I think you need to revisit whether or not you're using sustainability terminology. Maybe it's too early for you. But there will be a requirement in here for fund managers to say what holdings they've got in the portfolio that might at first glance appear to be out of line with the strategy of the portfolio. Now, that often happens. You often get companies where the asset manager knows that there's been a lot of investment in a particular area and the company is in the process of changing very substantially. But we would expect that kind of thing now to be flagged up front so that the fund manager doesn't get accused of greenwash. So this is kind of having your backs, getting information out there in the public domain so that people know what to expect when they're investing in a particular fund. And this is also further underpinned by the anti-greenwash rule, where basically it's going to be seen as being obviously wrong and a regulatory process that sits behind people misleading people on environmental and social issues, because clients don't like it, we don't like it. A lot of people are often having to answer questions on it, so let's just get it out there in the domain that we know that this is a regulatory issue now. The recognition of being part of the chain, I think, is hugely important. I think the FCA in this area and in many areas has not always understood how it kind of works from cradle to grave, or from, if you like, manufacturer to end investor. That's been addressed in this paper. Fantastic. It's been well signposted. There's been lots of information out and about for a long time on this. And also the concept that sustainable funds will have to use words proportionately and appropriately and sensibly in a way that would make sense to an investor who is minded to invest in this kind of fund, i.e. a person who's got a deep interest in this area and actually wants to do something differently. So you would be expected to understand what they do. But if you're running a fund that's not all about sustainability and you're using those terms, you'll be expected to use those new protected terms appropriately, proportionately and sensibly in a way that doesn't make clients think that you're doing more than you actually do. So just clear sort of guidance around what you can and can't say. Doesn't mean to say you can't ever use those words. You just got to use them in the right way and sensibly in a way that's not misleading. So like I've said, these are my views, my interpretation, my understanding, apart from where I've lifted the bullets from the paper. but it's important to think about where we go next, what's going to happen from here on in. I'm going to start with this one, which is not to be taken too seriously as an image, but basically understanding the future of investment generally is moving towards, and increasingly does include, stewardship activity and ESG risk integration. I would say that anybody who's looking to select or recommend a fund, if they say that they don't do ESG integration, that should be a complete warning for you now. Everyone should be thinking about environmental, social and governance issues, how a company is managed. And that is the way we're moving towards, which is why a fund that only does stewardship and ESG integration is not going to be sufficient to qualify for using one of these labels, because that is increasingly becoming business as usual. Okay, so what are we going to have? The main thing you're going to be seeing is these three labels. So sustainable focus, sustainable improver, sustainable impact. Within each of these labels, so there will be diversity of strategies. Okay, you're not expecting all the funds to be similar, so they'll be multifaceted. They will pick up on different aspects like stock selection, like stewardship. They will have different strategies for different environmental issues, different social issues. Do not expect identikit funds. Don't be expected to design them. That would create bubbles that would help nobody. All of this is underpinned by an anti-greenwash rule which goes live probably mid-23. So when the policy paper for this comes out, that's when we're expecting the anti-greenwash rule to kick in. Frankly, it's there in regulation pretty much already anyway, because we know that we mustn't mislead people. But anyway, so the clarity around it will start probably next year, or 2023. Other rules will mostly come in 2024. The entity level reporting, you won't be expected to produce the first reports until you've gone through a full year of the process, so that takes us to 2025. Bear in mind, this is designed for retail. This is all about helping individual investors, okay? So keep your focus on what you produce being on that market. Understand this is about guardrails, not rules, so don't be expected to be, not going to be spoon-fed exactly what you've got to do and say in a particular area. You're expected to come up with your strategy and then explain what you do and why and prove it. And ultimately, this should make the whole area easier to understand and explain to clients, and improve trust and enable it to grow, so that we can help to address those sustainability challenges that we face, whilst giving clients a better experience of the investment markets. And just a few words to say on how we're helping on the fund eco market side. As you know, we're involved with the FCA, helping to feed information through and make sure that this all really works for the industry. We want it to be stretching, but we don't want it to be impossible. We're trying to raise standards and make sure that we end greenwash, and that we help to move towards where the industry's got to get to in order to finance the changes that we need and support companies that are doing good things. On Fund Eco Market, we're changing all the filter options. This should be coming through early 2023. So different areas within different boxes on our filter options on our fund tool, which, as you know, is whole of market in this area in retail. And we've redesigned the SDR services site. You'll see that's gone live already. There's the app, which is also free to download and use. Dial shifter stuff will probably be coming after we've really got cracking on the SDR, and once that becomes once it becomes more in place and more settled. So lots happening, and we're supporting, trying to make this easier, as clients will be looking more and more closely at this area over time. We want to help them to do so, and we want this information, that what fund managers say they do, to get in front of clients, and that's the purpose of our tool. And on a final, more general thought, just keep in mind, if you don't understand the logic of this, then obviously the paper doesn't make sense. But the logic that underpins all of this is, if the way we lead our lives is not sustainable, that makes it unsustainable, which means it can't carry on forever. And that is a problem not just for younger people alive today, but actually for a lot of people on the planet today. We can tell that with greenhouse gas emissions rising, levels of floods, fires, etc., we do not want that getting significantly worse. In fact, we want it to get better. So sustainable investment is part of the puzzle. It's not the entire answer, but it's part of it. So we need to shift our lives to being sustainable, which means we need to shift companies to being sustainable. So if something's not sustainable, it can't carry on. We want things to be able to carry on, whether it's business, humankind, or whatever. So that's what underpins all of this. You have the link to the FCA paper, in fact the landing page where they've got the press release and links to all the related documents that I've mentioned throughout the course of this presentation on the screen in front of you here. Realistically, if you Google FCA SDR, it'll come up as well. And just to say also, please do respond. If you work in this area, if you've got strong opinions on this area, this is a consultation paper. The object of the exercise is to get input from people in order to make the paper as good and as useful and as client friendly and as workable as it can be. So please do respond to the consultation. And with that, I will say thank you for listening. You've got our website address there, the SRI Services website address. The Fund Eco Market address will be closed down fairly soon, but it's still live at the moment. So SRI Services is our main address. Be aware we're not authorised to offer advice. We're just trying to get the right information in front of people. That's what our database is for. That is what our work is for, helping get the system working better. Thank you for listening. Please, can I ask you one final request? Please subscribe to our YouTube channel. That really helps us. And I hope you've enjoyed it, and do please get in touch with me if you should have any queries. Thank you.